Welcome to Financial Wellbeing with Emirates NBD, the podcast that helps you foster a healthier relationship with your money. I'm your host, Dana Kamber. In a fast-paced world like the UAE, we often find ourselves chasing for the next best thing. But when it comes to your finances, sometimes slow and steady wins the race to your wealth. I'm joined today with Satyajit Singh, Head of Fixed Income at Emirates NBD. Together, we'll be deep diving into the steady world of fixed income investments. Thank you so much, Satya, for being on the podcast here with us. Let's start off with, what are fixed income and how do they differ from other investment assets?
Great question, Dana. But the name is income, fixed income. So when you buy stock, you are owner of the company.
Mm-hmm.
But when you are investing in fixed income, you are buying a bond, you are lending to the company. You are not an owner, but you have higher demand on the cash flows of the company.
Okay.
And when you say fixed, right, like any other thing, there are exceptions to this. There are floating rate bonds, there are variable rate bonds, there are sinkable bonds. We're not going to details of that. But typically a bond has a coupon, which a client, when they invest in their fixed income bonds, they get that coupon semi-annually.
Mm-hmm.
That's why it's known as fixed income.
And that coupon, what does that signify?
It exactly signifies a percentage that you get. For example, if you put in $100 in a particular bond, if the coupon is 6%, then annually you are supposed to get $6, which is basically 6% of $100. And that's your cash flow.
Okay, so you get the return of your bond investment annually.
Absolutely.
When someone refers to a bond, it's essentially basically loaning the money to a company. Is that it?
Exactly. It's not bond 007, but it's something that you loan to the company. For example, when you become an owner of the company, right, your shares, you depend on the growth of the company.
Mm-hmm.
But when you loan some money to the company, you become a creditor to the company. Or you can also loan your money to the governments, right? Of course, you cannot be a stock owner or shareholder of a government. But this way, you also participate in the story of sovereigns, right? If you want, you can actually loan money to the government of Abu Dhabi, right?
Mm-hmm.
How many stock owners can comment on that?
Yeah, it's a very good point, actually. To be part of the governmental growth, that's quite, impactful. What are sukuks and how do they differ from bonds if they do?
Sukuks are Sharia-compliant counterparts of bonds.
Okay.
But in reality, if you invest in sukuks, it's very similar to investing in bonds, just that you are doing it within the Islamic finance framework that has been approved by the higher Sharia authorities.
So essentially, it's Sharia-compliant bonds.
Absolutely.
Correct.
The Sharia-compliant bonds, you get instead of coupons, you get your profit rates semi-annually, and that's it.
Many people think that investing in fixed incomes is very slow to see rewards and the return. Is that true, or are there other aspects to it?
I would say for 90% of the cases that is true. You typically get a 5%, 6% gain every year. Depends again on where the interest rates are. But there are opportunities where I have seen investors getting 10%, 20%, but that's not the norm. It's not an NVIDIA where you're going to get a 5x kind of return within 5 years.
Yeah.
You should not expect that.
And how do you suggest someone balances between that steady growth of a fixed income and, other aspects of their portfolio, let's just say?
Asset allocation. These are two words which are most important for any investor, right? For the growth part of your portfolio, you invest in equities, which give you probably 5x, 10x growth over the 5-10 years. But then there is the stability part of your portfolio, which you do not want to let go. And that's where you invest in fixed income so that you get your returns in time without affecting the total value of your portfolio. So there is a place for both. And you have to know at what stage of your life you're in to properly allocate your assets between these two important asset classes.
And how do you suggest someone determines that stage and knowing what works best for them?
So typically, a rough estimate is that 100 minus your age should be invested in equities. That percentage of your portfolio should be invested in equities. For example, if you are a 30-year-old, 100 minus 30 is 70. So 70% in equities, 30% in bonds. But of course, it also depends on your risk appetite. Like you have more risk appetite, you have more experience. So you could increase your allocation to stocks and decrease your allocation to bonds. But at the same time, if you're risk averse, then probably you'd want to be more in bonds and less in stocks. So
Yeah.
all boils down to your experience, to your risk appetite, and to your investment horizon.
So when you say investment horizon, essentially, which is when, someone wants to have access to their money by X amount of time, right?
Absolutely.
So how does that factor in, like you mentioned briefly, into deciding whether you're looking at a bond or you're looking at equity investments? And how can someone determine their own time horizon?
So let's talk about time horizons, right? You want to buy a house in, let's say, 5 years, and you want to retire, let's say, in 30 years, right? Then you have to have two different portfolio allocations for both of them. Let's talk about the house horizon. That's your horizon is fixed. It's 5 years. And in such a short time period, it's better to have more fixed income allocation within your portfolio versus a retirement portfolio, let's say 30 years. You probably could go into 100% or 90% stocks because it's a long time, over a long time horizon. Even if I'm a fixed income analyst, I think we should all be in stocks. Being out of the market is the biggest risk at this point of time.
I like that. Being out of the market is the biggest risk. And when it comes to fixed income, is that something that you would recommend for someone planning for retirement?
I would say fixed income always has a bit of place in everyone's portfolio, regardless of whether you are approaching retirement or you are saving for your school education or you want to buy a house 2 years down the road. Fixed income can always match the duration. The best part of fixed income is that you can determine a bond which has a maturity matching your cash flow requirements. Let's say you want to buy a car 2 years down the line. You can buy a 2-year bond. And when you want to buy a car, that bond matures and you get your money back at that point of time. So I would say there is a part in everyone's portfolio for fixed income.
So the bonds can be 2 years or could be longer. Could they be shorter as well?
They could be so shorter as well. For example, the treasury bills that are issued, they are less than 1 year. They could be 3 months, they could be 1 month, they could be 6 months, right? So they could be as short as you want or as long as you want. I mean, we have 100-year bonds, for example.
No, that's really interesting, actually. So you can basically adjust it based on your own needs and time horizon, right?
Yes.
Are the shorter bonds typically higher returns?
Not really. Typically, if you see the yield curve, is basically, so I would say uncertainty increases with the increase in time, right? And for an investor, you demand more returns for more uncertainty, right? So typically, if you see a yield curve, it is upward sloping. That means short duration bonds will give you low returns because there is low uncertainty. Long duration bonds, because they have high uncertainty, they will give you more returns. So you demand higher coupons, higher yields from them.
And then the more uncertainty we go into equity, the higher returns.
Absolutely. Absolutely.
Yeah. Let's talk a little bit about the fixed incomes that we have available in the UAE. What are the different types of bonds that we have access to over here?
So the UAE, if you look at the fixed income markets, you can typically divide them into two parts. One is government and government-related entities, like let's say the Emirate of Dubai, Emirate of Abu Dhabi, the government of the UAE. They issue their bonds, obviously, to fulfill their long and strategic projects. Similarly, you have corporates which issue a lot of bonds as well. Then you have bonds which are issued in dollars, euro, those kind of currencies, right? And then also you have a recent phenomenon where you have dirham bonds which are being issued, dirham sukuks which are being issued. They are great opportunities for both institutions as well as retailers to diversify their asset classes. For example, what did you do with your dirham assets, right? You typically used to buy real estate. You typically used to put your money in fixed deposit, right? Now you can buy government bonds, government sukuks, which are denominated in dirhams. I mean, which are pretty safe, I would say.
Do you see a shift in trend moving more towards bonds in the recent years?
I won't say it's a trend as such, but definitely there is an opportunity that is coming up, I would say. I mean, if you look at the important families, where did they put their money? Where did they generate their wealth from? It was from real estate, it was from trade, and they typically parked it in fixed deposits, right? Or they invested more in real estate to generate returns. With the opening of the capital markets, with more and more equity IPOs coming, with more fixed income options available, even crypto options available, I think what I've seen is that both institutions and the retail investors within UAE, they are broadening their, I would say, investment asset classes. They have access to really good platforms to invest in all of these different asset classes. So I see a lot of money moving from fixed deposits as well as real estate into these asset classes, which are, I would say, very liquid, to be honest.
Yeah, I think that accessibility really does help within the UAE, right?
Yes.
Is there a minimum amount that someone needs to put in order for them to invest in a bond?
Yes. Typically, on an average, you would require a minimum of $200,000 to invest in bonds, right? That's why bonds or fixed income typically have in the territory of institutional investors or very high net worth investors. So new fixed income instruments are coming to the town. For example, ETFs have been there, right? You can invest in ETFs from as low as $100, $50, depends where the NAV is trading at as such. But what is more important is that there are a lot of fractional bonds, fractional sukuks that are coming out as well. I mean, Emirates NBD, I'm proud to say that we were the first bank within the UAE to launch fractional bonds where with a minimum investment of $5,000, you can invest in a bond, right? Let's say you had $200,000. Earlier, you used to invest in only one bond. That increases your risk, to be honest. Now, with that $200,000, you can invest, let's say, in 40 bonds. So you can diversify sector-wise, country-wise, and that actually improves your portfolio returns and risk metrics as such.
That's so fractional bonds are like a percentage of a full bond.
Yes.
And are those accessible through ETF or you can invest directly?
You can invest them directly through our platforms.
And how do fixed incomes behave in someone's portfolio to complement the other investment assets?
That's a great question, Dana. I mean, that's why we talk about asset allocation, right? You must have heard that people take fixed income is a safe asset class. While that's not completely true, I would say that it is typically less volatile than equities, right? So whenever equities, let's say, fall 30, 40%, you typically expect bonds not to fall more than 10% or 5%. That way, your overall portfolio is protected. And you don't really feel bad if you have, let's say, a 50% fixed income, a 50% equity, instead of the whole portfolio going down 50%, probably will be down 20 or 10%, depends how much is allocated. So that acts as a lifeboat for your portfolio. And then obviously equities recover and your fixed income continues to pay you income. So probably after 2-3 years of drawdowns, you'll be okay.
And is that why fixed income are often looked at as stabilizer in a portfolio?
Yes, absolutely.
Let's build a little bit on risk. So what are the biggest risks associated with fixed income investments?
First and foremost, as a fixed income investor, you should focus on credit risk, right? Because it's not only return on capital, it's also return of capital. Remember that at the end of the bond maturity, you are supposed to get your money back. If you do not get your money back, if the company or the government that you put your money in goes bankrupt or defaults on the bond, then that money doesn't come back to you, right? So that's why you should focus first on the credit risk. Second risk, which a lot of people tend to ignore, is interest rate risk. Typically, when interest rates go up, for example, Fed had been increasing their interest rates in 2022. At that point of time, fixed income, bonds, and sukuks, both of them go down in value. The longer the bond maturity is, the more they go down in value, right? So that's why we saw some very strong issuers bonds, 2070 bonds, 2060 bonds, go down by almost 20-25%, even though there is no credit risk, right? So that's something that you have to keep in your mind. And that's why your investment horizon is very important when you invest in bonds. And third risk, which almost everyone neglects, is reinvestment risk. Whenever you get your coupons, right? For example, you have invested $100. There's a coupon of 6%. So you are getting your $6 every year. Now, how do you invest that $6? So unless you invest that $6 properly, at the end of the bond maturity, you are not going to get an yield of actual 6%. So you have to be very smart in investing those coupons as well.
Interesting. So you should ideally, whatever coupon and return you get, you should reinvest that in.
Ideally, you should reinvest that. Yes.
And to the same bond.
It's difficult because, again, if you're investing a fractional part of that bond, yes, you can do that. Otherwise, you can invest in stocks, you can invest in fixed deposits if the rates have gone up. Actually, it depends on what you want to do with that. But ideally, it should be reinvested for the maturity of the bond.
Oh, yeah. So basically reinvested into your portfolio as a whole, essentially, right?
Exactly.
You know, a lot of people are going into trading, right?
Mhm.
And they get that instant gratification, that instant reward that they seek when it comes to trading. How can someone's mindset be shifted for them to basically, appreciate the steady growth of a fixed income investment?
When you talk about trading, it's mostly in the equities, to be honest, because most of the platforms currently allow equity trading, right, online, and the capital required is not much. You have options, you have futures, which allows you to trade. The fixed income side is a little bit different because first of all, the capital required is a lot bigger compared to equities. I don't think there are platforms available where you can freely trade bonds online. It's still done the old-fashioned way through phone calls on brokerage screens, through trader interactions. So unfortunately, you cannot trade bonds unless you are in a bank's treasury or you're working with a proper hedge fund, right? But talking about mindset, that is very important. Trades typically what we have seen is that, especially the retail trades, are very leveraged. A lot of people trade CFDs, options, without understanding the underlying risks to that. So there is a good chance that you might blow up your account, right? And that's not great, right? That's why I think whenever you have a goal, assess what is your risk appetite, assess what is your horizon. At the end of the day, remember when you are trading, you are actually competing against professionals who have access to a lot more data, who have faster systems than you. You are basically competing against the system, and the house always wins at the end.
That's
So
true.
I think investing is a much better and a safer alternative than trading to actually increase your goal.
So that mindset shift from someone to appreciate that consistent growth when it comes to fixed income, what are your suggestions for someone to basically look at their portfolio differently and introduce fixed income towards their mix?
I would say the first thing that you should look at is think about yourself a lot more, right? Uh, what kind of drawdowns you are comfortable with? Are you comfortable losing 50% of your capital within one day? Uh, what do you want to utilize your wealth? A lot of us do not actually think about what we want to do about wealth. We run after wealth. Um, See, it's I personally think that wealth is not the end; it's a means to get something,
Yeah.
right? So if you understand what you want to do with your wealth, then you would have a horizon, investment horizon. And depending on that investment horizon, you can allocate your portfolio. And that's where fixed income can play a great role.
I really like what you said with a lot of people don't really know what to do with their wealth, right? They're seeking wealth,
Yes.
but they don't know what they want to do with it when they get there or, why they're seeking that wealth, right?
I completely agree with you on this front. You know, wealth, as I mentioned, it should be a means, it should not be an end, right? Personally, for me, for example, wealth means freedom, right? Freedom over my own time, freedom to do whatever I like, freedom to travel, freedom to eat, or freedom not to do anything if I want, right? So once you understand what you want to do with your wealth, I think you'll be a much more streamlined in terms of your investments.
It's a very good point. I think a lot of times people fall into what's trending, you right, and then they react based off of that. How can someone basically be confident into their decision to basically invest in fixed income versus like what other people might be doing, which is a bit more flashy, which is crypto or AI and things of that sort?
Um, the key is to understand your risk preferences, and for that, the important signal in fixed income is already there, right? For example, for stocks, you have analysts who give you buy or sell recommendation. In fixed income, you have rating agencies which give you their ratings, right? If you are a risk averse investor, then probably you should go for investment grade bonds, which are rated triple B minus or above. If you are a customer who is okay with risk, you can go into high yield bonds, which are rated double B plus or below, right? But you should always have discussions with your advisor, with people who work in this field to understand before you invest in these high yield bonds. To be honest, I mean, you have your Moody's and S&P and Fitch, these rating agencies, where the analysts go meet the management, do their cash flow analysis, and they make the rating observation based on two facts. One, does the company or the government have enough money to pay back their capital in the future? Second, do they have the willingness to do that? Right. So these are the two things that they look at. And as an outside investor, typically a lot of investors do not have access to such kind of data points, do not have such kind of access to the management of the company. So you should look at the ratings, but remember, the ratings are not the end of everything. In 2008, the great financial crisis, bonds which are rated AAA, which is the highest rating class, they also defaulted, right? So you have a signal, but you should always talk to your investor. Then you think about investing in fixed income.
And these rating agencies, are they accessible online, or how can someone get that information that you mentioned in order for them to make that informed decision?
Absolutely. Any bond that you have. So, for example, let's say for equities, how do you identify an equity? It's known as a ticker. Similarly, for bonds, the key identifier is known as ISIN. So once you put an ISIN into Google, and you can search and find out its ratings. It's absolutely freely available.
And it's easily accessible. If someone wants to do their due diligence and do that research aspect, they can easily find that online.
They can easily find out at least the rationale why this bond was rated, particularly, let's say, a AA or A or B. All of this information is freely available.
Let's talk a little bit about research, and going into and understanding a little bit about your investment asset before going into it. Obviously, AI is becoming very much popular right now, and even in the investment space and financial space. What's your perspective on AI advisory versus the traditional, human advisors?
So AI for me is a great aggregator of information, right? It's Google on steroids at the point of time. But is it great at advising you whether X bond is better than Y bond? I don't think so. It's still that. It will get there. Pretty sure it will get there. But at this point of time, all you can find is more information and more pinpointed information about the company that you are researching on. But then a human advisor can give you various other information that is not captured, right? For example, the sentiment of the market that cannot be captured by an AI. You can get that from a trader. The flows into particular bonds, you can get that from your advisor. So all of these are important points of investing in fixed income. And that's why at this point, at least, I think fixed income, you can take help of an AI, but do not make your decisions based on what are the inputs that you get from AI, to be honest.
Yes, so there's still that human element that has that space within the advisory.
And within all asset classes, I think bonds have the most human element because, as I mentioned, trading is not possible online. So humans trade it. Lot of information that is required to invest in bonds, again, not available through AI or online. You require human elements for that.
Yeah, I think that's a good thing for people to take note of, and do not forget where AI might be easily accessible. It's not going to give you that, concrete response that you need, right? What advice can you give for someone looking to consider introducing fixed income to their portfolio mix?
Be confident, be analytical, and manage your expectations. I have seen clients who have aimed for 6%, actually generating 7, 8, 9% from their fixed income portfolios. And I have seen investors who target 9%, 10%, go into high yield bonds, losing 30, 40% of your capital, right? So managing expectations is very important in fixed income.
So the mindset aspect of things, right? And what are the key takeaways you want our listeners to leave with today?
Have patience when you invest in fixed income. Doesn't matter what your horizon is, there is a place for fixed income in your portfolios. Do talk to human advisors when you invest.
And now for my last question. What's one trend you noticed here in the UAE that you yourself have changed your mind about around finances?
That's a personal question, yes. Honestly, because I have been a fixed income investor, so I have been biased, I would say a little pessimistically. I had missed investing in stocks, but I have changed that with the country specifically coming out with IPOs, broadening its markets, and looking at the fact that developed market equities the valuations are very, very rich. I think the local markets offer a lot of value, and that's something that I have been looking at. I have personally been investing. I would say that is the biggest shift in trend that has happened for me.
Yeah, that's a nice insight. I think so. You've seen the growth and you've kind of like evolved with that.
Yes, absolutely.
Thank you so much, Satya, for a very insightful conversation. I think that you basically took a complex topic and simplified it for our listeners. Thank you so much.
Thank you so much, Dana.
To everyone tuning in, remember that investing in fixed income may not offer the thrills of instant rewards, but it does offer something quite valuable, which is peace of mind and steady growth towards building your lasting wealth. Until next time, remember that sometimes the smartest move isn't chasing more, it's choosing calm.